Morning, everyone. Carl Fisher here from CamaPlan, and I'm very fortunate to have Attorney John Hyre with us to answer a few questions and give us his words of wisdom. John and I have known each other, I guess, almost close to 2 decades in the business. I think he's one of the people or attorneys that like to do battle with the IRS, and he's a deep thinker on questions with IRAs and tax overall. He's getting ready to move to Puerto Rico for tax reasons at the beginning of next year. And before we start, I'd just like to say that this is for educational purposes. We do not recommend or endorse any of our speakers or any of their products. So at this point, John, I'd like to turn it over to you. You've got a few questions that people have sent in, and if you can help us get through those, that would be great. And if I missed anything, help me out.
All right, so what we'll do, I'll introduce myself, and then I'll start going through the questions we've gotten. Now, we did get some questions that were not really IRA relevant. They were more like, hey, let's talk general tax planning. If we have time, I'll hit them, but frankly, those are at the end of the line since this is more of an IRA directed call. Let me introduce myself. My name's John Hyre. It's an odd spelling, H-Y-R-E. I'm an attorney with a nationwide practice because federal tax law is pretty much the same everywhere. And my two focuses, I have a rather specialized practice. I do a lot with self-directed IRAs and their cousins. So HSAs, Coverdale educational savings accounts, 401ks. I get involved very deeply in that. I'd say that's about 60% of my practice at this point. The other 40% is taxation of real estate and small business in general. Most of the practice is planning work. So we try to help people reduce taxes. We do a lot of analysis of people's existing business, their books, their returns, their narrative, their entity structure, and come up with ways to do better. I am one of the few lawyers you will ever meet who has actually taken self-directed IRA cases to tax court. It is, believe it or not, comparatively easy and cheap to sue the IRS in a specialized court known as the tax court. I've taken 2 self-directed IRA cases to the tax court. I won both of them. The IRS said the client had prohibited transactions. They owed 150 and 500 grand respectively, and we got it reduced to 0 pre-trial, which was great because avoiding the expense of the actual trial, talking the trial attorney at the IRS who has limited time into the idea that, hey, you're going to lose, you really need to concede, is way more efficient for the client than winning a trial. Granted, I'd love to win a trial because it gets my name out there, but for the client, it's much better that we settle beforehand. A note about the tax court. If you ever get audited and the audit goes badly, you very quickly want to talk to a tax attorney. I do take tax court cases nationwide. Thankfully, it's a circuit court, so they come to Columbus once a year, and I hear all my cases here. That way the client doesn't have to pay me to travel. Plus, I kind of know the local lawyers and some of the appeals agents, so we have a sense of how to work with each other. We have gotten some great results. You've got to understand that 97% of the cases that go to tax court are going to settle. Only about 3% are going to go to trial. And by settle, I mean the taxpayer pays something less than the auditor says they owe. So it is very much in your advantage. If you get audited or you know someone who does, tax court is extremely powerful, and it is surprisingly cost effective. Basically, if you owe the IRS more than 10 grand, it's usually worth going. So just to give you some background on what I do, it's mostly planning, mostly tax reduction, about 60% self-directed IRAs and kissing cousins, about 40% real estate and small business outside of the IRAs. And of my time, I'd say probably 85% is spent planning, 5% speaking like this, and 10% fighting, be it in audits or in tax court. So that's my background to give you an idea of with whom you're speaking. let me tell you what else I do in order to be very good at IRAs, and then I'll hit the questions, because I do think these qualifications matter. One, I belong to an organization, and Carl's a member as well, that we see lobbyists, or not lobbyists, boy, that was a Freudian slip. We see bureaucrats and regulators once a year in DC, and we get a sense of what they're looking at and thinking about and what their priorities are. The other thing I do is I fly to the tax court at least once a year, and it's the only place where you can pull the full case. In other words, when there's a tax court case, the published piece you see online is just a decision. There's way, way, way more to it. Usually, if I go for one case to review the record fills a shopping cart. The tax returns, the IRS attorney's briefs, which are very interesting to me, the transcript of the cross-examination of the taxpayer, which is also very interesting to me. So I go and pull the important cases, and I look at them in great detail, starting with the IRS lawyer's arguments in the brief that most people never bother to look up. And it's not cheap. It's 50 cents a page for government photocopies. So I spend a couple grand a year pulling detailed information that most other people don't see. And I think that's part of the reason that I've never lost going to the tax court. So far, every time I've gone, I've gotten the taxpayers way more than they paid me. Usually 8 to 12 times what they paid me is pretty common. Sometimes I do better. So that's some background. Bottom line is, this is what I do. I'm not one of these guys who speaks for a living and doesn't actually do what he talks about. And I think you're going to see that when it comes time to answer the questions, which is now. So I'm looking at the questions Carl sent me that you all sent in. So I'm going to cover the IRA specific questions that you all sent in. Carl, if there's a question on the screen that relates to something I'm talking about, feel free to interrupt me because I may or may not see it. Once I'm done with the questions that were sent in, I'm going to look at the IRA specific questions that you're typing into the chat box. And then if there's time left, I'll hit some of the non-IRA questions that you sent in, because some of you sent in some really general tax planning questions that I think are probably a little beyond the scope of the call. So,
hey, John, somebody said that you sound muffled. Did you change anything? They said you sounded better when we were talking. I don't know if you changed anything on your end.
How about this? Is this any better?
It is better. For me,
okay.
It sounds better.
Okay, very good. I just adjusted the speaker a little. I turned away from it. All right. The first question, how do you value partial notes? Example, you buy a note, a reperforming second lien, 20-year AM, 7% APR, blah, blah, blah. None of that really matters to the question. You buy a note. It's producing $310 a month. And 2 years later, you sell 120 of those payments for 20 grand. That's the key. 2 years later, you sell 120 of the payments for 20 grand. What is the net asset value of the remaining 96 payments? So it sounds like they sold the first 120 payments and then kept the remaining 96 payments of $310 a month. What's the value of the remaining 96 payments for purposes of converting those payments to a Roth? I think that's a very simple calculation. That should be something you can do yourself, with one exception. There's one issue here that's kind of subjective. Here's the easy part. This is just a net present value calculation. So in Excel, or I'm sure there are online calculators, I don't bother to use them because I'm pretty good with Excel spreadsheets. You run an Excel spreadsheet. You lay out, in this case, let's see, 96 plus 120, so 216 payments of $310 a month. You can run a net present value of any range. How much are the first 120 payments worth? How much are the last 96 payments worth, etc. Here's the subjective part. What's the discount rate? When you do a net present value calculation, you have to have what's called a discount rate to tell you how much money is worth year to year. And that discount rate is very subjective. The lower the discount rate, and by the way, for those of you who buy stuff, it's the same as a cap rate. The lower the cap rate or discount rate, the higher the value of the note and the payments. The higher the rate, say 12% instead of 8%, the lower the value of the stream of payments. So for purposes of valuing this, if you're selling, you want a low discount rate. And if you're valuing for tax purposes or buying, you want a high discount rate. You do have to be consistent. Let me tell you what not to do. Don't advertise it at a 8% discount rate to whoever's buying, and then tell the IRS I valued my portion at a 12% discount rate. That will make an auditor angry with good reason. You're being inconsistent. You're talking out of both sides of your mouth. So probably if you sold this at a certain interest rate to the investor, that should be your discount rate. So what I would do is reverse engineer what's the interest rate to the investor. If they paid me 20 grand for 120 payments, the first 120, there's a function on there called internal rate of return in Excel, IRR, internal rate of return. You can reverse engineer based on 120 payments for 20 grand. What's the rate of return the investor's getting? I would use that as your discount rate. I think it's an honest discount rate. Then to value the remaining 96 payments, I would apply that discount rate. Once you're used to doing this, it should take you no more than 5 minutes. It's a very simple process. So that's how I would value it. Would I feel comfortable defending that in tax court? Let's say the IRS audits and say they don't like your net present value on those remaining 96 payments. Am I comfortable fighting that or going to tax court based on the methodology I described? Very, very comfortable. Let me give you a hint. It would never see the tax court. They would settle that one up front. And my guess is settle really well, probably just give you what you want because it's a lousy fight for them. So in a nutshell, how do you value the remaining payments on a partial? I would use the net present value function in Excel. And as the discount rate, I would use whatever rate of return the person to whom you sold payments is getting. And you reverse engineer that rate of return using an IRR, internal rate of return function in Excel. You can also do this on a financial calculator for those of you who still use them.
And
Carl,
John,
do you have any?
If you do that, do you have to incorporate inflation going forward? The fact that it's 10 years down the road, or would that interfere with any of that, or could you take more of a discount as a result of that, since your cash most likely won't be worth as much 10 years from now?
You could try. I don't know that you have a real good argument because the interest rate is supposed to incorporate future expectations of inflation.
Okay.
And that cuts two ways. If I were an IRS agent and you did that, I'd come back and say, you know what? I think we're going to have deflation. And I would turn it around on you and say, I think money is going to be worth more. Things in this world are by and large getting cheaper. Now, we can argue whether or not that's so, but that's aggressive. Would I still defend it? Yeah. Do I think I have a high probability of winning that argument? Not especially.
Okay, that sounds good. I appreciate that. I think that's a good answer, and I think it's a way that a lot of our note buyers can approach this in the future. And I think if you converted that, like you said, at the Roth point, it would be hold up, and if not, hire John, and you wouldn't even have to go to trial, most likely.
Yep, odds are low you'd end up at trial, because I think you have a hell of an argument there. I don't think this is really very gray. Okay. All right, number 2. What is your opinion on buying distressed, non-performing notes in your IRA and personally doing the workouts, or hire someone to do the workout? All right, let me give you a little background, because that's a really good question, and there are really 2 angles here, both prohibited transactions as well as UBIT. So let's walk through this. First of all, we agree that prohibited transactions outside of a 401k are fatal to the account. They're absolutely fatal. The account dies, the money gets distributed, roughly half of it goes to the government, you get to keep roughly half of it, and it's no longer tax sheltered. So we avoid in IRAs, HSAs, and CISAs prohibited transactions at all costs. We're not just conservative, we are paranoid, because they are out to get you, and the consequence of being wrong is disastrous. Now, if this isn't a 401k, I still think we should be conservative, but one of the advantages of a 401k is that prohibited transactions do not destroy the account. Rather, they're penalized at 15% of the transaction per year. Let me give you an example. You have $1 million IRA, you lend your mother $1, you just lost 500 grand, right? About half the account goes to the government, the other half comes out to you, but it's no longer sheltered. On the other hand, if you have a 401k that lends $1 to your mom, the transaction's $1, the penalty is 15% a year, that's 15 cents a year. Until the IRS audits, once they audit, they give you time to correct the transaction, meaning mom has to pay back the dollar, or they fine you at 100% of the transaction. So prohibited transactions are fatal, and I am paranoid about avoiding them. Services, providing a service to your account is a prohibited transaction. It's clear, black and white in terms of how it's laid out. A service, if provided to your account, is a prohibited transaction, period. What's the problem? They've never defined what's a service. We have no idea. We have no idea. And to my knowledge so far, the government has not gone after someone for quote unquote providing a service to their account. Now, here's what some of you just heard. The government hasn't looked at it. I can do whatever I want. I'm going to go rehab my house. I'm not going to get caught. They're not looking for it. John said, I can do whatever I want. No, wrong. Not what I said. Back up. The government has not defined what's a service. They haven't gone after it yet, which is good. That's because A, they're grossly inefficient and incompetent, and B, there are so many people doing blatantly stupid things in their IRA, like lending their parents money out of their IRA or borrowing from their parents' IRAs, that the government has been satisfied and made quite a lot of money going after those basic 101 transactions. Will they one day go after services? Probably. They haven't yet. Here's your problem. You don't know what's a service, neither do I. You don't know if and when they're going to go after it. And if you're wrong, the account dies. So my direction, my strong preference is you avoid anything that could be a service until we get clarity. So you don't, I mean, here, I hear this, Carl, I'm sure you've heard this too. I hear a lot of lawyers, well, there are not a lot of them that do this, but there are a lot of lawyers that opine on it, even though they don't know what they're talking about, say, you know what? You can do whatever you want for your IRA as long as you don't swing a hammer. So for example, if you have a rental in your IRA, you can look for tenants and advertise for tenants and interview tenants, and when the tenants are finally in the property, you can be the person they call. And as long as you call a contractor to do the physical work, as long as you don't swing a hammer, you're safe. And I ask those attorneys, where did you get that? And nobody's been able to answer the question. It's this old wives' tale out there that as long as the work's not physical, you're safe. I don't agree with this. With my own IRA, I don't do, I direct. Let me repeat that. I don't do, I direct. Here's my question. Could managing a tenant without swinging a hammer, could that be viewed as a service? Well, yeah, that's what management companies do. Could running a rehab, hiring the subcontractors, approving every little thing, being at the house every day and supervising, could that be a service? It could. That's what general contractors do. What do we call it when you have a note and you are the one who makes sure that it's paid on time and call people if not and so on? That's called servicing. And here we're looking at the question. Let's go back to the question now. How about personally doing the workouts for a non-performing note? That makes me nervous. Could that be a service? It could be. Now, if you want to take the risk, it's your account. If you want to take the risk and you're thinking, you know what? They're not going to audit me. And if they do, how will they know? Because I get that question all the time. They're not going to catch me. Oh, then why ask me the question? If you're not going to get caught, do whatever you want. You can kill people, bury them in the backyard, and since nobody's going to ask why that one rose bush is growing really, really well, you're not going to get caught. So just do whatever you want. Well, that's not why I'm here. I'm here to tell you my view of the law. Now, you can decide whether or not to follow it. I have to recommend that you do so. I think working out non-performing notes in your IRA is possibly a service which is fatal to the IRA. Do you want to risk it? That's your call. It's your money. It's your retirement. You got to decide whether to do it. I'm going to recommend against it. The second issue is this. If you're doing enough of that, and especially if you're selling all or part of the note, you almost certainly have a UBIT issue. In other words, once you've done enough, you can put enough in quotes. We don't have any case law. We don't have any case law that says you owe UBIT. I better explain what that is. IRAs are tax-free, except when they're not. That's right. Sometimes your IRA is taxable. There are three things that cause this tax called UBIT, UBIT, unrelated business income tax. Think of it as IRA tax. I think UBIT is a stupid name. Think of it as IRA tax. What causes this UBIT IRA tax? Three things. You rent out personal property. So your IRA has automobiles or meth labs or furniture, and it rents it out. That's all personal property. It's not real property. That would cause UBIT. Second, you borrow. Your IRA leverages and borrows and acquires an asset with the borrowed funds. The income from the asset would give rise to UBIT. And finally, if you run an ongoing, and the proper word is continuous trade or business. If you run a continuous trade or business in your IRA, you pay UBIT. Now, it's very gray. What's a continuous trade or business? That is not always clear. So if you do a few workouts and sell the note, is that a continuous trade or business? Let's say someone else does the workouts. You delegate it, you hire someone, and you can still supervise them. It's not completely hands-off or completely passive. But I think if you hire someone to do it, even if you're supervising them fairly closely, I think the IRS is probably not going to want to go for that issue. So I would say a few of those deals probably doesn't create UBIT. Now, what's a few? Who knows? And what's your pattern? Do you do 6 deals a year for 12 years? That's probably a continuous trade or business. Do you do 2 deals? And I'm saying where you actually sell the note. I'm going to talk about holding it in a minute. If you sell the note, and this applies to flips as well. We get the same issue with flips. When you buy a property, you take title. I don't like assignments in IRAs. I hate assignments, and I hate options that do the same as an assignment. We'll talk about that if we have time. When I say flips, I mean the IRA takes title, perhaps rehabs the property and then sells it. It's going to be real similar to you acquire a note, you get it reperforming, and then you sell it. How many can you do before there's UBIT? We don't know. My recommendation, I would probably do 2 a year for 2 years and then skip a year. And what's my argument? Not continuous. If you do 25 in 1 year, you probably have a continuous trade or business in that 1 year. But we don't have any sense of the numbers. So if you want to avoid the UBIT, a couple recommendations. 1, hold the notes. Like the first example I had, they held it for 2 years and then sold a partial. I don't think that's a continuous trade or business. I think they were holding the note for the production of income, which is the definition of a capital asset and the sort of thing the government likes to see you have in an IRA. So that's one option. Hold it. 2, limit your volume. If you're going to sell, limit the volume the way I described. 3, sometimes it's just so profitable to incur UBIT that you're like, look, I'm better off paying the tax. We can lower the tax. If you're going to do, let's say you're going to hire someone, you're going to buy 50 seconds a year, and you're going to hire someone to get them reperforming, and you're going to sell a large percentage of them. That's a continuous trade or business. Instead of paying 37% UBIT tax, so it's a high tax, 37% federal plus the state rate, you can pay a much lower rate, set up what's called a blocker corporation. If you have an ongoing continuous trade or business in your IRA, you're better off having the IRA own a C corporation and pay the 21% corporate rate instead of the 37% UBIT rate. Now, you got to be careful drafting those. That's very specialized work. I happen to know a lawyer who does those. We have a guy, for example, who is running 100 buy, rehab, and sell deals through a C corporation, paying 21%, which, by the way, is lower than his personal bracket. His personal bracket's the top bracket, 37%. He's paying 21%, running a bunch of flips through a C corp that is 100% owned by his Roth IRA. So what happens? He pays 21%. Does he pay double tax when the money comes out of the C Corp to the Roth? No. The money comes out tax-free. So he pays the 21%, 16 points less than what he normally pays. And he's pumping, in this guy's case, he's pumping almost $1 million a year into his Roth IRA. Now, what's the key? He doesn't do the work. He has staff. That corporation has staff that runs the flips. He does a little bit of supervision. He takes no check. He doesn't get crazy or stupid by abusing the word supervision to cross the line into what would clearly be a service. So a long answer. I had to explain to you why. It's not enough to tell you just a quick answer. I have to give you the background and explain why so you understand where we're coming from. Carl, does this answer make sense? Did I miss something?
No, I think you hit on all the points that most people need to, because there was a couple other questions that popped up, but I think you got them pretty well situated in this. One of the things that I hear a lot is, hey, you know, I can go out and in the old days, I could buy a newspaper and do my research. I could go to the library and do my research on stocks and bonds and mutual funds, and then I could buy them, and that wasn't considered a service to my IRA. It was educating myself. And I guess today you can go on the internet and buy software or review software that helps you pick stocks and bonds and for your IRA. So that's where a lot of people say, hey, that's supervision or that's reviewing, and it's not actually working in the business. It's working on it maybe. So I think,
yeah,
you know, when
and that's
the question.
And that's just not going to fly if you're doing, look, you can research the IRA's investment all you want. You can spend 100 hours researching which note to buy or which property to buy, and that's not going to be a service. But when here you get into negotiating a workout, you're no longer researching the note. You own the note. You've stepped beyond researching it, and now there's risk. Look, and if you're going to do that, if you're not going to get caught because you're special, and you're going to go ahead and do the work, then at least do it in a separate IRA. If the tax court follows the law, and they normally do, that's a problem, by the way. A lot of courts don't follow the law. They just do whatever the hell they feel like. The tax court's pretty good about following the law. If you're going to do this sort of thing, do it in a separate IRA. That way, if it is a service, you only blow up that IRA.
No, that's great. That's great advice. And we have a lot of clients that if it's even questionable, they'll separate the IRA money out and do what's questionable in one IRA and basically protect the other one.
Carl, I'm going to skip question number 3. I'm going to come back to it time permitting. And the reason is this: it was really vague. And it's one of those situations where these guys heard something online or they talked to a guru, and they're doing something that's quote unquote clever, but not clear. They muddied the water. It's not clear to me on that question what they're doing, that the language is too vague. And so for that one, that's the kind, and we get these calls all the time. A client will call with a transaction and they think they know the transaction, and then I start asking questions and I get silence on the other end. So I'm going to come back to number 3 if time permits. Number 4, Checkbook IRA LLC. Any concerns with those? IRA owner's manager or a non-disqualified person? First of all, there is a vast amount of garbage on the internet when it comes to Checkbook LLCs, and most of the lawyers who write on it have no idea what they're talking about. They saw a quick way to make money. Here's what they do. They get a template, God only knows where. They don't have experience with the IRS. Some of these are not even tax lawyers, and some of the ones who are tax lawyers clearly have not taken the time to understand IRAs. I can just tell from looking at their advertisements and their operating agreements, they don't go to tax court. They don't go do the research. They don't talk to the custodians. I talk to custodians and listen, what are the odd things you're seeing? So the preface is, most of those lawyers just want to sell you a template and set up a Checkbook LLC with very little work and make their money in about an hour of work, and they're done. And if you blow it up or screw it up, they don't really care, which is stupid because I think there's malpractice exposure out there if they let you loose with something you don't know how to use. So where am I at with Checkbook LLC IRAs? Most of the the information on the internet is raw garbage. They make sense in three situations. If you don't have one of these three situations, I think you're wasting your money setting one of these up. I think you're falling prey to the marketing techniques that are out on the internet. The three situations where one of these IRA-owned LLCs, aka Checkbook LLC, makes sense. One, you need the asset protection. For example, I do low-income rentals in my IRA. I need asset protection with those, and the IRA does not provide asset protection. It does not have a liability shield the way an LLC does. But if you're lending money, is that a risky thing from an asset protection standpoint? Not really. Second, you need to cut a check on the spot. You go to an auction and they need a check on the spot. So you need to have that checkbook control, that ability to write the check on the spot, because the custodian, no matter how good they are, can't do that. That's a valid situation. You're missing out on deals where you need to write a check on the spot. Finally, if you have a really high volume of transactions that are low dollar, high volume, and it's driving up your custodial fees. I don't know that this applies to CamaPlan, but some of the other custodians charge, for example, I know people who do like 400 or 500 tax lien purchases per year. Average purchase price, let's say $1,000, and they'll do 400 or 500 a year. And the custodian, not CamaPlan, but the custodian puts a fee on each of those. Let's say $50. That gets expensive quick. That might be cheaper to run through an LLC. What are some thoughts on the Checkbook LLC? Don't be cheap. Talk to a lawyer that knows what they're doing and will actually walk through the rules with you, not just set up the LLC, slam, bam, thank you, ma'am. And I have it happen all the time. The custodian sends someone to me to set up a Checkbook LLC, and they say, we found someone cheaper on the internet, will you match the price? And I say no, because I'm actually giving you advice and walking you through the transaction. Well, I already read about the transaction. Where? On the internet. Okay, so you know prohibited transactions. Oh yeah, I understand them. I don't really need your help. Okay. Then I ask them one or two questions, and if they're clueless, I get rid of them. I won't work with those people at any price. It's too much exposure, too much liability, and they're too cheap. I tell them, you know what? Go pay $300-400 for the template. Go do whatever you want. And when you get audited, come to me. It'll be way more expensive. So pay for quality. A couple things I like to see with these. I prefer from a tax standpoint, and we're going to talk about swapping risks, but from the tax standpoint, I don't like to see these self-managed. I don't like to see you act as the manager unless your role is extremely limited. For example, we set up cryptocurrency LLCs, and really all you do is pick the cryptocurrency and cut a check for it. You don't do much else. So for you to provide a service or for you to engage in a prohibited transaction is pretty low. You would have to work at it. You'd actually have to try to create a prohibited transaction in that situation. That's very different than, let's say you have a rental property and you're doing way more than writing checks. Now I get nervous and I start thinking about, are you going to use this thing properly? That's where I prefer to see a crony, a non-disqualified person as the manager of the LLC and paid to be the manager. The IRS looks for Checkbook LLCs. They're clearly looking at them. I've had auditors tell me this, and we've heard it from the people in DC. We haven't seen them act real hard on it. But Carl, you have a case up on your website, an article I wrote. If you remember the Neiman case, N-I-E-M-A-N-N. I wrote an article on the first Checkbook LLC case. The first case to use that term was the Neiman case, a guy in Arizona. And this guy was so smart that the tax court actually put in writing, Neiman's really freaking smart. And he screwed it up. He paid $250 to buy a template and committed immediate and obvious prohibited transactions in there. So what do you really need to learn if you're going to use one of these Checkbook LLCs? A, ask yourself if you really need it. B, from a tax standpoint, we prefer to see a non-disqualified person be the manager. And by the way, your definition of non-disqualified and mine are pretty different, because here's what a lot of you think. Well, I'm not related by blood or marriage to the person who's the manager, so they're non-disqualified. They're good. Wrong. Let me give you one example. You come to me, you've never met me, you've never dealt with me. We shake hands. We don't have a piece of paper. We shake hands and have a joint venture where I put up money and you go do a rehab. So I put in the money, you put in the sweat equity. You are a disqualified person as to me. You are disqualified as to my IRA and vice versa. Most of you don't know that. The rules are a lot deeper and more subtle than you think. So what's the other requirement of having a Checkbook LLC? You need to know that the prohibited transaction rules cold. And I mean cold. And not just from I read it somewhere, but some real thought and brainstorming with someone who knows what they're doing. Otherwise, handing a Checkbook LLC is like handing a flamethrower and matches to a 12-year-old pyromaniac. We know what's going to happen. What's the risk from using someone else as the manager? That they run off with the money. They got bank account access. They're able to write checks. Oh no, John, I have the checks and they sign them ahead of time. Or I use a signature stamp. I'm really the one doing the checks. Then they're not really a manager. It's a bogus transaction. Well, I don't know if I can trust anyone to do that. Then I guess you better take the tax risk and manage it yourself. But understand the IRA or the IRS looks for that. And by the way, I dislike checkbook trusts. 99 times out of 100, an IRA-owned LLC is a better option than an IRA-owned trust. There are a few instances where a trust makes more sense, but I'm going to tell you this. Very few people understand trust law, and trust law is much more local. You come and say, John, I want an IRA-owned LLC in Pennsylvania, I'll set it up. You come and say, John, I want an IRA-owned trust in Pennsylvania, I will not set it up for any price. And when the lawyer tells you, I don't want your money, that ought to make you think. There are some of you out there who have a fetish about trusts. The trusts are essentially your deity. You think that they're magical and allow you to do all sorts of clever, hidden things that you could otherwise never do. You are mistaken. And don't send me emails telling me I don't understand trusts. Been practicing law for 23 years with taxes, trusts. I've dealt with the IRS on them. I've dealt with the Attorney General on them. I do understand trusts. So with the Checkbook LLC, I prefer a separate manager from a tax standpoint that's non-disqualified. You need to understand the prohibited transaction rules cold, and you need to think about those three things I said. Do you need the asset protection? Do you need to cut a check now? Or do you have so many transactions that the custodial fees are killing you? If the answer is yes to one of those three, it may make sense. If the answer is no to those three, I don't think you need one. I think you're complicating your life for no good reason. Did I miss anything on that, Carl? Do you disagree with any of that?
No, all of that sounds good, but we just had, he wasn't a client, but it was with another custodian, and he had a checkbook IRA and he hadn't filed income tax returns, and they were trying to fine his LLC for not filing the tax returns. So even though everybody thinks they know it, I do think with a checkbook IRA LLC that you still need to have whoever set it up for you tied into your reporting every year and or your transactions, because we do see a lot of people make stupid mistakes. Like the LLC will buy a property and they'll sign on the note as the manager of the LLC, and I'm just kind of going, oh, and it's a recourse note at that point too. And they said, I knew that was prohibited. I don't know why I did it.
I can do it. I am a manager of an LLC and I can magically now do things that I'm not allowed to do, or I just don't have to do my homework. Let me tell you what, if the person who sets up your Checkbook LLC doesn't ask, what are you going to do with it, and modify the language and talk to you about prohibited transactions in UBIT, they're just a template salesman. They don't care if you succeed or not. They just want your money, and they're going to spend about an hour running their template and setting up the LLC that supposedly was well done, well drafted, and thought through. I have seen so much garbage in that regard, and it makes me mad. Because I could make a lot of money if I were less ethical. I could do that, and I just won't do it. It's just not right. Take a look at that case that Carl has the article on the website, the Neiman case, about how this guy screwed up his Checkbook LLC. And he was a brilliant man. If you read what he did, he was a brilliant man. He just didn't do his homework.
And John, I do appreciate that you do put those articles out every now and then from your studies at the tax courts and things. So please keep that up, because I do think it's valuable to a lot of people, and especially our clients.
Oh, we'll send you some more. All right, there are a few questions we already answered. Let me hit them. Can you put sweat equity into an IRA property? No, I think it's a prohibited transaction. I think it's going to be a service if you're not real lucky, and an over contribution if you are lucky. What's an over contribution, also known as an excess contribution? If you make an excess contribution to your IRA, you pay a 6% per year fine, and the fine can be higher depending on, did you file the return, which typically you didn't report it, etc. But it's a lot less bad, right? It's not as bad as a prohibited transaction. But I think sweat equity into an IRA property, especially if it's physical, you're running the risk of a service. You got to decide if you want to run the risk. Somebody, and this is a common one, this is a great question. The Swanson case for Checkbook IRA LLCs. Can it be used for Checkbook IRA trusts or other entities? All right, first of all, if somebody on the internet says the Swanson case says you can use Checkbook LLCs, write this down. If they say or imply that the Swanson case means Checkbook LLCs are okay, delete. They're an idiot. They didn't read the case. That's not what Swanson says. Swanson was a very, very narrow ruling that says if you fund a C corporation from your IRA, the initial funding transaction is not a prohibited transaction. That's all it says. It does not endorse Checkbook LLCs. It doesn't discuss anything outside of the C Corp context, and it discusses damn little within the C Corp context. Swanson is a very narrow case. It is not carte blanche to just run off and set up LLCs for your IRA. If I had a nickel for every idiot's website that said that, I'd be a much wealthier man than I am. And then I talked about the checkbook trusts. Trusts are more complex than LLCs. They rarely make sense compared to an LLC. Sometimes they will. Give you an example. California, LLCs are very expensive. And I want to have 3 people pull their money to invest in one note. I might do that through a trust if I were in California. The trust might be cheaper than the LLC since I don't have the $800 a year fee plus the initial setup cost. So that's one example of where I think a trust can make sense. But for the most part, IRA-owned trusts are inferior to LLCs. They don't provide asset protection. They're much more complex, even though the people who sell them to you claim they're not. I have seen in my practice, because that's what I do, I actually practice. You guys set up things like entities or trusts that you don't maintain properly, right? The joke I always like to use is creating an LLC or a trust is like creating a child. It's fun and easy, but then there's a lot of work and maintenance and expense involved, and most of you fall down on that. And I am telling you, trust maintenance is a lot harder than LLC maintenance. You better, if you're going to use IRA-owned trusts, you better go and learn from someone who knows what they're doing. I'm going to throw out a name. It's the only person I trust to teach you how to do trusts correctly. Dykes Bodiford, D-Y-C-H-E-S, Bodiford. He does a really good job of teaching you how to use trusts. If you're going to use them, if you're going to take the time to learn it, talk to him. I don't see very many. There are probably 1 or 2 other people I like. Names are not coming to mind. But most of the trust salesmen are charlatans. They're even worse than the Checkbook LLC salesman. What are my thoughts on the Rollins case? This is an important case, a very important case. Rollins, R-O-L-L-I-N-S. What happened was Rollins owned personally less than 50% interest in 3 different corporations. I think the interest levels were like 19%, 12%, 9%, something like that. It was low percentages. So Rollins made a loan from his IRA to each of these companies because the code says if you make a loan from your IRA to a company you own 50% or more of, directly or indirectly, so if you have a trust that owns 24% and you own 26%, you still own 50%. Directly or indirectly, you own 50% or more, you're not allowed to lend to it. That's a prohibited transaction. And Rollins said, well, I own way less than 50%. Therefore, my IRA can lend to the corporation. Wrong. He blew up his IRA. There is a more subtle set of prohibited transaction rules that say you may never use an IRA asset to benefit yourself. You may never use an IRA-owned asset to benefit yourself, no matter how small or indirect the benefit. For example, your IRA owns a condo in Florida. You stay the night in the condo. You're done. The IRA is dead. You used an IRA asset for your benefit. Your wife stays in the condo. You're dead. She's a disqualified person. Your mistress stays in the condo. She's not disqualified, John. I can have my mistress stay in there because we're not married. Well, wait a minute. By letting the mistress stay there, did you get a benefit? I hope so. Otherwise, you've missed the whole concept of mistress. And ladies, just reverse the terms, right? Bottom line is this, all humor aside, if you get a personal benefit from an IRA asset, you blew up the IRA. And so what the court came back is they said, Rollins, your company's got cheap loans from your IRA. They got loans that probably they couldn't have gotten anywhere else. So Rollins, you blew up your IRA. Now, some of you are thinking, oh, well, I'll just document when I make a loan to my IRA that it could have gotten the same terms elsewhere, therefore there is no benefit. Well, the burden of proof is on you. You have to prove to the IRS there's no benefit. That's harder. You know, that's proving a negative, guys. I wouldn't go there. I wouldn't do anything that could be a benefit. Here's a common one we see. I want to buy a property personally for 100 grand. I've only got 80 grand. I'll bring in my IRA as a partner because everyone tells me I can partner with my IRA. I read it on the internet on a Checkbook LLC site that sells trusts. I read it on the internet. I can partner with my IRA. I don't need to talk to some lawyer because that's expensive. And so I'm going to partner with my IRA. There's a property for 100 grand. I've got 80. My IRA is going to bring the other 20. You just blew up your IRA if they catch it. Why? Because it allowed you to get into the deal. It bootstrapped you into the deal. You got to show you could have gotten into the deal without it on better terms. You got to show that. And even then, it better be good proof because remember, the burden of proof is on you. I won't get caught. Oh, okay. Well, then why listen to the call? Do whatever you want. Here's the deal, guys. I've been through IRS audits on IRAs. They dig. I had one IRA audit that involved a trust. So the IRA owned a trust and did a lot of business in the trust. The auditor called the trustee. The auditor called the property manager. The auditor called contractors. Now, we got them off the phone quick and said this has to be in writing. So we were able to get the questions and answers done in writing instead of phone calls. And the auditor got a slap on the wrist because he wasn't supposed to call directly. And he asked these people, what do you do? And what does the IRA owner do? Oh, well, he was over here rehabbing with me. That's not what happened in that case, thankfully. Thankfully, the IRA owner in this case was smart enough to direct and not do. He hired everything out. And the hirelings were able to honestly say in writing to the IRS, he doesn't work on the property. So they were digging to see what he does. I don't know if they were looking for the services angle or not. We never got to that point. But I want you to understand that when they do audit, they can look really deep and they can ask questions and people are going to sing like little birdies. That's just how it works. Carl, what did I miss on that one before I move along to, I get away from Rollins and I go to, let's see, number 10, question number 10 that you sent me.
Yep. No, I don't think you missed anything on that. And we've got a bunch of other questions. How much time do you have this morning, John?
I can go till 11:30. So we planned on going for an hour, but I can throw in an extra half hour. But at 11:30, my coach turns into a pumpkin.
All righty. Well, we've got a few extra questions out here. So
okay. And hopefully people don't mind the wordiness. I'm not being wordy just to hear myself talk. There's a context to these questions. It's not a simple yes, no, okay. And I really want you to understand the context.
No, John, I think this is the reason I had John is because I think we need that. Everybody wants to do things in sound bites and, texting and get an answer. And it just causes way too many problems down the road. He said, she said, and I just want to mitigate what people are thinking out there from little tidbits that they get on on some blog somewhere. So
Yep.
thanks a lot
Yep.
for the answers, and just keep it up. You're doing great in my point of view.
All right, question number 10. Is it possible to get an exception from the IRS that an asset purchased by my self-directed IRA can subsequently be purchased by me personally? Yeah, I've seen this with property that someone wants to buy from their IRA and live in personally, or otherwise convert to personal use. You can get a letter ruling. You have to have a damn good appraisal. They want to make sure that you're paying a fair price and probably err on the side of overpaying a little bit. You can get a letter ruling. I've never done one of those. I don't have a sense. Carl, do you have any sense of what those cost?
Last time I looked, it was like $16,000, and it took about a year and a half to get.
Oh, wow. Oh, I got to start doing some of those. I bet I can beat that price and still make good money.
Probably, but
yeah, that now
and it,
now you got me curious.
yeah,
I didn't realize they were
well,
that pricey.
yeah, and it's more of a prohibited transaction exemption is what they
Right.
is what I'm talking about, not
Yep.
just a letter ruling.
All right, so there's a good answer. I know I've seen people get letter rulings. I've never had a sense of the cost. Carl just gave us a sense. I think that's a bit high. I think I can do better, but it's still real money. So if you're going to do it, it better matter to you a lot just to be willing to have that transaction cost to get a prohibited transaction exemption from the Department of Labor on that. Question number 12. Let's see, I've used CamaPlan for a Roth and traditional IRA to do hard money loans. Do both IRA types act in the same way if they're contained equities? I have no idea what that means. Roth IRA is forever untaxed, traditional tax on the money withdrawn. Yes. I don't know what that means. Here, let me give you an idea here. If you've got two different accounts and they're doing hard money lending, for example, ideally they each do their own things separately and they don't partner. Why? It's just simpler. It's harder to screw things up, right? I like simple. Plus, simple costs you less money with me. When you start adding complexity like IRAs partnering, I bill more hours, which I thank you for. I appreciate it. I just don't think as a businessman you should do that when it's not necessary. So if each account can do the deals on its own, then I would not partner. Now here's a question, and I think I already gave you the answer. Let me give you a hint. Your traditional IRA is a disqualified person with respect to your Roth IRA. And your Roth IRA is a disqualified person with respect to your traditional IRA. So for example, your Roth IRA cannot lend your traditional IRA money. Well, remember the Rollins case. You cannot use your IRA to benefit a disqualified person. If your, for example, traditional IRA is used to benefit your Roth IRA, that's a prohibited transaction. So what if you use your traditional IRA to bootstrap your Roth IRA into a deal? I think that's a prohibited transaction. So once again, we have to be careful. People make these generalizations. Well, disqualified persons can partner. I read on the internet my IRAs can partner. I read I can partner with my IRAs. There's more to it, guys. There are questions that have to be asked. The details matter. And asking those questions on the clock and exploring those details on the clock is a cost. Now, sometimes it's worth it. But once again, if those accounts can do business on their own, why don't you avoid paying me the money to teach you how to get in the partner? Why not keep things simple? Are there annual reporting requirements that need to be done when filing state and federal returns? It depends. I mean, your IRA typically does not have a reporting requirement unless one of two things happens. Either A, you incur UBIT, in which case you file a Form 990T. B, you have an excess contribution, then you file a Form 5329. And I lied, there's a third one I can think of right off the top of my head. C, if you have a partnership or you have an LLC which is treated like a partnership, or you have a handshake joint venture with no paperwork that's treated like a partnership by the IRS, you have to file a partnership return. Those are the three most common instances when an IRA is filing tax returns. If you don't have one of those three, odds are pretty low you're filing a return unless it owns some other sort of entity, maybe a blocker, a UBIT blocker or the like. Carl, before we hit the other questions, let me throw two ideas out there I wanted to run by everybody. If you partner with someone, I should say if your IRA partners with someone who has a continuous trader business. For example, your IRA partners on flips. It brings in the money, the other guy does the work, your IRA gets half the profit. You're paying UBIT. The activity of the partner is attributed to your IRA. The activity of the entity is attributed to the IRA. So if you invest in a private placement memorandum and you're only a 1% partner, but the private placement memorandum is an LLC that does flipping or development, that's a continuous trader business. You're paying UBIT. Or if they borrow money, let's say it borrows 80% and uses your IRA's money as 20% down, you're paying UBIT. Be aware of that. What's the way around that? There's a wonderful way around that in some of these deals. A shared appreciation mortgage, also known as a participating loan, a shared appreciation mortgage. So instead of my IRA partnering with a flipper and paying UBIT, my IRA lends the flipper money, and the interest rate is defined as 50% of the profit. So it's a note, but it has an interest rate that's 50% of the profit. That gets you around UBIT. What's the catch? You better have someone who knows what they're doing draft it. There are rules. The tax court, if you put loan on a document, the tax court will not accept it as a loan unless certain criteria are met. There's a lot of case law on when is something a partnership or a JV or equity, and when is something a loan. And you want to make sure, given how much UBIT costs if you're wrong, that you've got a well-drafted shared appreciation mortgage. This avoids UBIT. It gets you around partnering with people on certain types of deals. So I wanted to throw that one out there. It's a common technique we see to reduce UBIT. Carl, what other questions do we have out there?
We got one. What are the main issues the IRS looks for when examining self-directed IRAs?
What are the main issues the IRS looks for when examining self-directed IRAs? Well, they go after prohibited transactions in UBIT. That's what makes them money. When they're looking for prohibited transactions, they take a very close look at who do you lease to? Who do you rent from? Who do you lend to? Who do you borrow from? Who did you sell to? Who did you buy from? They do look at the conflict of interest issue. That's the one where we were talking about the condominium that you or your spouse or your mistress stayed in. They look closely at, were you using the IRA to help yourself? And that's gray and contextual. So they tend to look at all the deals and ask a lot of questions on each deal. Now, some of the agents don't have the time or are flat out lazy, and they only look at some of the deals. Some of them are pretty thorough, and they do try to go through everything. But they look at the deals and look at the details of what happened. What did you do with it? They do put more scrutiny on Roths because their attitude on traditionals is they're going to get paid one day. So they tend to look more at high balance Roths. They do not like Checkbook LLCs. They tend to dig into them. They tend to look for very rapid increases in value that they want an explanation. You had $100, now you have 100,000 within a year. Let's talk. They're really interested in knowing how that was done, and they start asking who did what. So I would say that's a good general answer. They kind of look for a gut feel on. They start with a gut feel of what did you do, and then do they think to themselves, does that make sense? And remember, they're not thinking from an entrepreneur standpoint. They're thinking from a bureaucrat standpoint. So something that might make perfect sense to an entrepreneur may not make sense to them.
No, you're 100% right, John. And about 5 years ago, 4 or 5 years ago, they made us, all the custodians, start identifying. They gave us 7 categories to put hard to value assets in on the 1099s and the 5498s, so that they have a much better way to find out what the assets are that you're looking for. And what we've heard and seen from some of our contacts is, like you said, Checkbook LLCs, and the other one is unsecured notes as 2 high areas that they look at to the other ones that you mentioned.
Yep. And part of their concern, part of it's the rules, but part of it is they don't like to see people investing in shady stuff. They don't want, on the one hand, they're willing to blow the account up and mess up your retirement, but it's contradicted by they don't like you. The reason they don't like unsecured notes, one of them is economically, it's just not a good deal for your IRA. I would never invest my IRA in an unsecured note. There's nobody I trust that much. Second, a lot of the time, the unsecured notes are really a secret way to funnel money. We see that all the time. I need my IRA's money. I can't take it directly. I lend John 50,000 from my IRA. He lends me 50,000 from his IRA. So something you could not do directly, you did indirectly. It's still going to blow up if they catch it. What you've done is increase the ante. The odds of them catching that are lower than a direct loan from your IRA to you. But if they catch it, it's clear that you knew you shouldn't do it and you were hiding it from them. Now they start digging. Now they start going deep. They start penalizing. They start expanding the audit to your personal life, to your entities. Because then they're like, you SOB, you think you're clever. You think you can hide from us. You're a real smart, slick guy. We're going to teach you about smart and slick. And I've seen that more than once, both in the IRA context and outside the IRA context. When they catch a slickster, they start opening everything up and pounding. Don't be a slickster. Be aggressive. Guys, I hate your money going to them. I love these accounts. If they're done right, I think they're the #1 tax savings technique out there. The only thing that comes close is me moving to Puerto Rico to run my business from there and pay 6% on my federal, state, and local combined tax rate for my law practice. That's why I'm moving there. Most of you can't do that. I know of no other technique that comes close. These IRAs are wonderful. Don't get too damn smart for your own good.
Great answer, John. Here's another one. Why is adding capital to an existing IRA LLC prohibited?
Depends on the nature of the LLC. Here's my opinion. Some of the custodians differ. First of all, let's be clear on our details. It's a non-corporate LLC because LLCs can elect to be taxed as corporations, and sometimes in the case of a UBIT blocker, for example, that makes sense. Let's assume first it's a single member LLC. I don't have any problem with an IRA putting money into a single member LLC over and over again and pulling money out over and over again, because under tax law, a single member LLC is not recognized as being distinct from the IRA. So transactions between a whole 100% owned non-corporate LLC and an IRA under tax law are intra-account, not intra-account transactions. So I have no problem with it, but I've seen some custodians prohibit that. Here's where it becomes a problem. This goes back to the Swanson case. Without going into detail, the Swanson court said, while we allow you to contribute money to a C corporation when you form it, so you get a one-time contribution, a second contribution of capital to a C corporation by an IRA, I should say by 100% owned or majority owned C corporation by an IRA, is prohibited. And I'm not going to go into the details of why. So here's what the problem is. Corporate and LLC law tax-wise are different but similar. Different but similar. So there's a possibility that based on that judge's comment in Swanson, that if you have an LLC that is more than 100%, or how do I put this? If you have an LLC that is less than 100% owned by your IRA, meaning there's a partner. So you have an LLC with a partner, and more than 50% of the partners are disqualified persons, that could be a prohibited transaction based on the Swanson case. Let me repeat that. If you have a multi-member LLC and 50% or more of the owners are disqualified persons, contributing money to that LLC second or third or fourth time could be a prohibited transaction. The law is unclear. We prefer not to take the risk. If the LLC owns 100% of the LLC and the LLC is not taxed as a corporation, I don't think there's any problem with money going in and out. Some custodians differ with me on that.
The one thing you said you weren't going into it, but where some of the attorneys tell us that the manager of the LLC is now a disqualified person because it's a fiduciary of your IRA.
I agree.
And so for that reason, that's why they don't want to, because now you're putting money in. When you first do it, you don't have the fiduciary, what do you call it? You don't have the fiduciary. He's not a fiduciary to your IRA, but once you put the money in there, then he is. So adding more money to it is there. But I've yet to see the IRS bring this up in court and give us a precedent. So
they've never gone after it. I'd never heard of it or thought of it, so I'm glad you brought it up. And even by my standards, like I said, I'm paranoid about prohibited transactions. So I don't know what you call something that's beyond paranoid, but I tend to think that is, because I don't see which of the prohibited transaction statutory provisions we're violating by allowing a fiduciary to manage more money than they're already managing. Now, there are issues with how you pay the fiduciary, right? You could get into some issues there depending on how they're compensated. And maybe this is a shotgun way to just avoid the issue altogether. That's my guess. That's my guess as to the thinking. But that strikes me as, even by my standards of paranoia, rather out there.
Gotcha. And it's always been a point of contention, and there's so many attorneys that have different opinions on it.
And that's why it's so important for the attorneys to tell you why they're telling you what they're telling you, so you can make a decision on where you want to go. How do you feel about their reasoning, their judgment, their feel for the system, and your own personal sense of probabilities? That is why this discussion of why we feel as we do is so important.
Gotcha. Can two IRA LLCs purchase a property, one property?
Depends on the details. Yeah, yes, depending on the details.
Yeah, it sounds like
it's real similar. It's real similar to what I said about IRAs partnering with Roths or you partnering with your IRA. It's similar issues. Yes, but.
Right. Is writing a check a service? Going back to your big question in the beginning there in quotations, I use my SDIRA, my self-directed IRA, to invest in a real estate management company. So I'm assuming they're talking about writing a check and they're running a real estate management company out of their SDIRA.
Probably not, but I can't say for sure. Probably not. And here's my reasoning, just so you know my reasoning. One, the IRS likes slam dunk cases. So the first time they go after someone for services, it'll be someone who was really hands-on, not just writing checks. Second, I think that's a dangerous precedent for them to attempt to set, because functionally we all write a check. Let's say you have a 401k at Microsoft and you click on a button to buy a mutual fund. Isn't that the equivalent of writing a check? Isn't that just like researching? That's the two things you're allowed to do, is move money from your 401k or IRA to places and pick the assets. So I think just writing the check alone is very, very unlikely to be a service. Now, I won't say 0% because we live in a funny world and very little is 0%, but I think it's really darned unlikely.
I thought that, when I first read it, but if I go on to it, I use my SDIRA to invest in a real estate management company. If you're doing ongoing real estate management, is that now a trader business? And is UBIT?
Well, it depends on, yes, you might have UBIT.
Okay.
Yeah, it depends on, that question's by nature a little vague, because when people say something like, I invest in a company, that doesn't tell me if it's a loan, if it's a partnership, what's the nature of the partnership? Are you just putting in money? Are you passive? And yeah, I agree. I think if it's a real estate management company, there's probably a UBIT issue.
Okay. Here's a great question, talking about your blogs and the internet services where you buy your templates. What's the rule for using an SDIRA to invest in a business? I've heard if the investor owns less than 50% of the business, they can be involved. I've also heard the same rules apply for an investor being hands-on with a real estate transaction.
All right, so let's think this through a minute. First of all, with the exception of ROBs, and I'll talk about those in a second. So ROBS, rollover business startup. With the exception of ROBs, you can't provide a service to the company. Now, people have done it, right? I always get this thrown at me. Some Silicon Valley guy owns a big piece of the company through his Roth IRA. So John, it can be done, and you need to be creative and show me how to do it because I know it can be done. No, just like Romney, that guy was so far ahead of the curve, the IRS never figured out they should even audit him. And had they audited, they wouldn't have known what to do. If you look at some of the stuff Romney did back in the 90s to get his SEP IRA up to about somewhere between 20 and 100 million, that would not fly today. He was so far ahead of the curve, they didn't even realize people were doing that, much less have a clue as to what to do about it. You should not work for. You got two problems. The big problem is if I were an IRS attorney and you invest your IRA in a startup that you also work in, A, if you're getting a salary, I'm going to say it's a personal benefit. B, even if you're not getting a salary, I'm going to argue it's a service indirectly provided through the entity because the IRS looks at direct and indirect. So when you buy into a startup, it's one that you shouldn't work for. Now, let's say you own a piece of something, you don't work for it, and you want your IRA to own a piece. Well, functionally, the IRA is, or you're selling yourself a share. Let's say you own 40%, someone else non-disqualified owns 60%, and your IRA buys in the 20%. Now the math is redone. You shifted your interest low. Your personal interest is now less than 60%. So unless your IRA bought from the other guy, you just bought from you indirectly. That's flat out prohibited. Let's say you bought from the other guy. Does it somehow benefit you? I don't know enough. I mean, that's where we have to get into the details. Let's say you own it 40-60, some outside guy owns 60%, your IRA buys 20%. First of all, the entity is now more than 50% owned by disqualified persons, so you have to be careful. But I have to look at the circumstances. Why did you buy? How much did you pay? Because people get really clever, wink, wink, and sometimes they just unintentionally do things they shouldn't. So this whole discussion is fraught with risk. It doesn't mean it can't be done. These are the kinds of ones where I generate some pretty good billable hours looking at the details and trying to structure it. There is something called a rollover business startup, where a 401k can basically you form a C corporation, you form a 401k, you roll money into the 401k buys the business. Couple thoughts on that. A, everybody gets to buy a piece of the business, not just you. Any employee anyone who's employed by that company that you're starting up gets to have a 401k and gets to invest the 401k in the business. So congratulations, you got partners. Oh, I'll just tell them behind the scenes, wink, wink, they shouldn't do that or they're fired. That is highly illegal. You shouldn't do that. So you got partners. Second, there's an issue with the buying. You're essentially having the 401k buy the company from you, and that's normally a prohibited transaction. There's an exemption for that. The problem is that exemption doesn't say anything about working for the company, providing a service to the company, or benefit to the company. And I've talked to some pretty sharp lawyers who have some pretty good arguments for why they think that exemption does cover services and personal benefit. I think it's gray. Now, thankfully, it looks like the Department of Labor is not going after that particular aspect of the transactions. They don't seem interested in it. So that can be a way to do it. Just remember, you may have partners, and some of the law is gray, and it only works with a 401k. It does not work with ROBS, does not work with an IRA. So bottom line, if you're going to start a company, funding it with your IRA is complex and problematic, to say the least. The ideal is you buy into a startup that someone else is starting up. That's the ideal.
I like it. Here's another one that came in. If my IRA owns real estate, a house or a condominium or a building, can the IRA sell it, get get a down payment in cash and also hold the mortgage or note for the buyer.
Yeah, can an IRA sell a property on owner financing? Sure, no problem. You got to make sure that they're not a disqualified person. And remember, selling on financing, if you do enough of it, is still dealer activity. In other words, if I buy 20 properties in my IRA and sell all 20 on owner financing, that's probably UBIT taxable. That's an ongoing trade or business. Whether you took cash or whether you took paper makes no difference. You flipped 20 houses, unless you rented it for, let's say, 2 years, right? If you rent a place to someone, which is classic non-UBIT investment activity, and then you sell the rental on payments, you probably are not going to have a UBIT issue. But can you do the owner financing in general? Sure.
Yeah. It's really no different than buying a note, right? You're just making one up.
Yeah.
So here's another question from somebody in New Jersey, I'm assuming. In New Jersey, there's an 8.9% tax on the sale of real estate. If it's bought by a self-directed IRA, do you need to pay it to New Jersey?
I have no idea. I didn't even know that law existed. It doesn't surprise me. Here's my recommendation. Move somewhere that's not run by communists.
Yeah, I do think, you know, for some of the IRAs that we've had in that situation, I do believe they've had to pay the tax. And there's also a tax in New Jersey that if you don't live in New Jersey, you have to pay an additional tax when you sell property in New Jersey. So we have to kind of look at that as, like you said, the more they tax, the tougher it's going to get. And also Philadelphia, when we started out, and all the bigger cities, Detroit's doing it too. They're trying to charge IRAs a tax because it used to be that if the feds didn't do it, then the city didn't do it, but they actually changed their statutes, and they're charging anybody who rents property, it's equivalent to an occupational license or a rental license, something like that, and they do tax them based on the income, and they do want it from. Say it again, John.
What a bunch of swine.
Yeah, so that has started, and that's one of the reasons we get a tax ID number, you know, for all IRAs that are needing to get licenses and things in different cities and states. It's just another tax.
And you have those huge transfer taxes in PA as well on real estate.
Yes. You know, all different states have different taxes, and I don't expect you to know them all. You're probably good with Ohio, and probably will be good with Puerto Rico.
I'm good at a bunch of them, but there's some stuff I don't know, but I usually learn it. I hate New Jersey. They're such a pain to deal with. Them, California, and New York.
Okay. John, I'm going to talk to you offline, and we'll probably set up another Q&A session, because I think this is very good if you'll do that with me. But we're running out of time, and I know you turn into a pumpkin. Would you say, would you give a couple of ahas or what people should be looking for in real estate or with IRAs or just generally with the Trump tax changes, what they should be going for, and you know, any ideas off the top of your head?
Yeah, I did an 8-hour webinar on the new tax law changes, and we just got some new regs out, which I'm going to spend some more time on. It's awesome. It's massively pro small business. It's like the new code section 199A, this pass-through deduction, is very small business friendly. I'm talking, if your small business nets, after all expenses, nets $100,000, you're probably entitled to a $20,000 deduction. That's huge because it's shaving off the top bracket. So it's really more than a 20% cut in your tax. That's massive. There's been some speculation lately that rentals do not get that benefit. And I disagree completely. I've researched this law in great depth. Most landlords should be able to benefit from that 20% deduction, assuming that they're going to show tax, because one of the other benefits of this new tax law, when you buy a rental, if you're buying a rental property, and I don't mean brand new, I mean you're just buying a rental, it's new to you as opposed to a new build, you should be able to write off about 15% of the property. In other words, if you buy a property for 100 grand, in year one, you should be looking at about a $15,000 tax deduction by careful and intelligent use of asset segregation, because the new law changed asset segregation and the benefit of it. And Carl, that would apply, for example, with UBIT. Let's say you have a property, a rental that's leveraged in your IRA. I would be very aggressive with the depreciation to get around the UBIT, because anything that works for normal taxes works for UBIT. So can you 1031 a UBIT property in your IRA into another property and avoid UBIT on the sale altogether? Yes. This pass-through deduction, this 20% write-off on the pass-through deduction, does that apply to IRAs? There's no clarity. I think it does. I give us 2/3 chance it's going to apply to IRAs and 401ks. Again, it only matters if you've got UBIT. But let's say you're running a flipping business in your IRA and you pay UBIT. Am I going to take 20% deduction? You better believe it. So it's interesting, the new tax law. Now, one of the bad things about the new tax law, you're no longer allowed to mix different UBIT activities for offsetting gain and loss. Let's say you flip properties in your IRA enough that causes UBIT, and you've also got some leveraged rentals in your IRA that have UBIT but at a loss. Used to be those two would offset, now they don't. And the real question will become, let's say you have 6 rentals in your IRA, all leveraged, 2 make a loss, 4 make a gain. Will the loss offset the gain? It's not clear. The law was poorly written in that regard. It's not clear. The aggressive position is, I'm going to offset because the rentals are all one trader business. The IRS's counter argument would be each rental is a trader business, and therefore you cannot mix the losses to offset the gains. But the new tax law, there's so much to it that, I mean, we spent a lot of time, it was a lot like this, it had me talking about half the time and Q&A half the time. We spent 8 hours on it, and that was before the new regs. So I'm grossly generalizing. But the salient, I think, IRA issues are going to be depreciation on UBIT generating rentals, the new UBIT changes, C corporations acting as blockers, which I already mentioned with the new 21% rate. And for UBIT situations, does the pass-through deduction apply? Now, a lot of IRA investors tend to have small businesses, so they're going to want to use that pass-through deduction. It's huge. You really want to spend some time planning and making sure you qualify and seeing if you don't qualify or you don't qualify completely, can you tweak to qualify? Because it's a huge deduction. 20% of your net income on a business is a very large sum. Add the depreciation bonuses, add some of the other subtle stuff that was thrown in there. It's very business friendly. Now, I haven't found a way around the people in the communist states that can no longer deduct more than $10,000 in local taxes. So if you live in a communist state like California and you're paying 40 grand in taxes per year in California, and now you can only deduct 10,000, there's no known way around that. It does give you an incentive to run your business through a C corporation and pay taxes through it, but there's a cost for that. And that analysis gets complicated. But otherwise, I don't know of any way around that. So that's my 2 cents. Hey, Carl, do you mind if I mention my website address?
No, not at all. I'd like for you to do that. And if there's a way that they can get access to that webinar, I would do that. I'd be glad for you to tell them.
So I can be found at iralawyer.com or realestatetaxlaw.com. And right now they go to the same website, iralawyer.com, realestatetaxlaw.com. My business is virtual. If you have questions, if you want to get into more detail beyond the call, I bill, and I bill well, but I also save people a ton of money. We do planning work. We fight the IRS. If you owe them money, sometimes we're able to negotiate a payment plan or even a drop in the tax. We do all that stuff nationwide. That's why I'm able to move to Puerto Rico. My practice is virtual. Less than 2% of my clients have ever seen my office. The vast majority of my business is over the phone and over the internet. So if you're looking for first quality tax planning, or you want a Checkbook LLC, or you want a blocker corporation, or participating loans, et cetera, this is what we do, guys. I'm sure from the phone call, you figured out I know what I'm doing. Am I any less obnoxious in person? No, I'm even worse. So if anything I said offended you, it's worse in person, it's worse on the phone, and it's worse in email. So if you've been triggered, probably should hire someone who thinks the way you do.
All right, John, I appreciate that. Can you just give out your email address, or your the website's the best way to get in contact with you?
There's a contact link on the website, but my assistant, who responds much faster than I do, my assistant is named Tina, and her email address is help@realestatetaxlaw.com. help@realestatetaxlaw.com, and she can help you set a time.
Great.
Oh, and the webinar is under products. If you go to the website, there's a products tab, and you can see that the webinar is there. And there's a pretty strong description of what it has and doesn't have and so on.
All right, John, I appreciate you giving us an extra half an hour, and thank you very much for coming on. I think what you gave was sound advice, and I'm looking forward to comments back on it, which people will be able to do when they sign off from this webinar, and I'll share those with you. And I'd like to set up another time because we do have other questions that I wasn't able to get to all of them.
Okay.
So have a great day, and again, thanks a lot.
My pleasure. Take care.